Welcome back to Cover Call Corner. I'm Danny Benson. Same caveats. These are my opinions and should not be taken as investment advice. Consult your investment advisor before making any investment. These transactions do have downside risk. This is my seventh week of looking at particular stocks or ETFs and doing a cover call analysis. Hopefully you find this informative. This week, it's the QQQs, which represents the NASDAQ 100 in an exchange-traded fund or an ETF. QQQ from Invesco. It's a broad play on technology. Recent moves in the 10-year US Treasury has had an impact on this ETF. It corrected probably in early March, but it's had a nice rebound in the last 2 weeks. Its potential longer-term play could roll this from week to week. Again, we will look at the numbers as we do our analysis. Of course, we always start with the options change. 4 basic parts. We look at the name, the Invesco QQQ Trust. QQQ is a symbol. We look at calls. Our expiration is the coming Friday, so just a week away. And we always look at strike prices so we can sell our calls at the bid prices. Using this information, we go ahead and we calculate our maximum profit screen. This research was done via my Schwab account today on Sunday, April 11th. And you can see after market, the price went down a little bit, but futures look like it might be bouncing back. So we're just going to use a Friday closing price of 337.11 and those closing prices from Friday for the option call prices. The one that comes out to me is at 337.11. Can it go up to 338, less than $1? That's not much of a move, but it could net me about a 1% gain, $336 on a $33,400 investment. That's about 1%, just over. So that's the one we'll look at more carefully and more closely. Here's the profit loss diagram. This is our purchase price around 337.11. Our break even, it goes down here to about 334.64. And here's our strike price of 338. That will cap out our profits. You can see we have a pretty wide range here in maneuvering with this. If QQQ finishes above 338 next Friday, we will not participate in any additional profits, but we will lock in $336 for a week. So, over 1%. And now here's comparing calls at various prices. So if you had written these calls from 334 to 340 or the no call, and this was the closing price, this would give you the value that you could have garnered out of the option or no option position. And typically, remember, if you hit the strike price right on with the stock expiration, that maximizes your gains. But notice that for the no calls, it goes down from 337 and below, could be losing money. You write a 334 call, you're making money. Okay, not much, a little less than half of 1%. But remember, 0.4% over the course of a year is a 20% rate of return for a year annualized. That's still outstanding stuff. So there's a downside protection sort of call you could write. I went with about the 1% gainer with the 338, but you could have gotten more aggressive and wrote a 340 call if you think the technology stocks will continue to run. So, there's many different opportunities here. All right, QQQ is the largest tech ETF. As I mentioned earlier, the 10-year US Treasury has calmed down, now trading at about 1.66%. It had gotten as high as about 1.77 a couple weeks ago. Why is the US Treasury bond sort of tied to tech stocks? Well, tech stocks rely on their cash flows of future earnings moving forward. If the long-term rate is higher over time, In the stock valuation models, that will increase the denominator, make the denominator bigger when you have a higher rate, which means that the future value or the net present value of future returns is less. And that would make the valuation model for the stock price to go down. Now that these rates have pulled back to 166, and still a lot of people are projecting the 10-year Treasury to go to 2% by the end of the year, which is still 8.5 months away. But it's, like I said, it's calmed down. It rose quite a bit from about 112 at the beginning of the year up to 177. It's now pulled back to 166. Some people see it stabilizing here, helping those valuation models calm down. A cyclical booms favor cyclicals, but tech stocks will also participate. When you have an economy that could be growing as much as 8 to 10% in the second quarter for the GDP, and you can see it, just go out, just look around, look at your local stores, look at the traffic on the streets. It's way more, as we're getting out of the pandemic, as more people are getting vaccinated more and more. So remember, writing calls helps reduce risk. And please remember, this is my opinion only. And as always, I always look at recent activity. The reopening continues to do well. One of my positions, Carnival Cruise Line, had a roller coaster week. The range of the stock price went down to started up near 30, went all the way down to 28, and then came all the way back to like 29.30 for the Friday close. Right now, I've currently split my calls at 28.5 and at 29 strikes. I'm still in the money. Still generating more than 1% by being conservative. It gives me some downside risk protection and still generating a lot of income. So I like it. Again, this bullet talks about what I just said. Long-term bond rates have stabilized. The Federal Reserve Board insists that any inflation that could be present in the economy will be temporary and not systemic. So, we could get a blip in inflation this year. It could be 2, 3, 4%. But the Fed's not overly worried about that because they think it's very short term and not a long-term phenomenon, that the economy will grow, then the economy will be right-sized and will then have the appropriate slack to accommodate any other additional price pressures. So we'll see how that works out. Recovery is an early cyclical play. So I continue refocusing on the reopening. That's what my portfolio is. QQQ is not a position I currently hold, but I'm looking at it for down the road. So that's this week's presentation. Hopefully it's short and sweet to the point. You can always back up the video and look at those charts a little bit more carefully and do more analysis. If you're looking at introductory investing, my son Derek Benson has a great video series on his channel. He posted a video this week on purchasing his first house, which he hopes to, he's got a contract in place and he's doing the financing for that, and he hopes to close on his new house in June. Very exciting times for my son. I'm excited for him. I remember buying my first house back in 1987. So basic investment advice, go to Derek Benson. I'm focused on covered calls. Go back and look at previous week's looks. Look at the different prices I had on those. Look at the prices now. See what would have happened if you rolled the options from week to week. That's what I've been doing. I've been pretty successful so far this year. I already had double-digit returns, and I'm midway into April. So I'm very hopeful for a nice year again, like I've had the last couple years with covered calls. So once again, I'm Denny Benson. This week's presentation on Covered Call Corner. I hope your week is profitable. And until next time, thank you.